Good evening, ladies and gentlemen. Today is the 3rd of June and also the weekly expiry. We opened gap up and right at the onset, straddle prices, I think, at the money straddle was at 65. So market was not pricing in even a test of 14,600 and 14,700. That was the way options were priced. And so when that is the perception of the market, it decided, okay, if that is the case, I will take a very risk off spread of 250 points, which should require absolutely no adjustment if the market perception of risk is so low. And more or less, market perception was perfectly all right. We did not see any move. We didn't see a test of 15,600 or 15,700. And I also benefited about 10 points from this because I had a very out the money position. Now, what is happening is we're transitioning to a phase where market is starting to price in lower and lower amount of volatility. I will wait until actual volatility in the market that is seen is at balance with the kind of volatility that is being priced in to then start looking at potential higher risk reward trades. Until then, I'm very comfortable being very risk off and just observing the market almost, and not having to fight against an assumption where there was supposed to be no volatility and then transitioning that into actually having volatility. It's a big headache. So all of that said, is still managed about 1% for the day. Being an expiry, it's definitely in favor of people who are taking credit. And I hope you had a good trading day. I think today's expiry was probably in a year, more than a year probably. This has had the most stable day the entire day, except for perhaps in the last 30 minutes where we saw a 40-point up move. But most people should have been able to get out of that if they were short. So thank you so much for watching. I will catch you tomorrow. Have a great evening.
Want to meet like minded traders and discuss option strategies, adjustments, and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
Good morning, ladies and gentlemen. I've just entered the position for today's expiry. We have opened gap up, which went in both Reliance Bank Nifty and IT. More or less, after the gap up, we have been relatively flat. So I have these Reliance 2200 calls which are bleeding because of the relentless up move. I sold them as a cover for my shares and they've expanded quite a bit. At different points, I took in put side credit. I took in credit from the 2000 Reliance put. I took from 2100 and I took from 2200, making half my position a short straddle. Now, what I have as two options, which I will consider either today or towards tomorrow's expiry. I'm not at all concerned by these calls bleeding because they are completely covered by my shares. So the two options are, one is start converting some of these calls to put. So rather than adding another two put shots at 2200, the idea will be square off one lot of 250 on the call side and convert that also into a 2200 put. My other option is square off this call altogether, roll forward to July and roll to probably the 300. So what will happen is, look at it this way. Even if you look at this trade in isolation without the puts at all, right now with these puts, my break even will anyway be 2300. But if you look at how much of a loss I'll be booking about 55 points of loss. Even if I book this 55 points of loss and sell the 2300 Reliance call for July, I will be getting 80 rupees, and 80 rupees will cover my 55 points of loss and give me an additional 25 points. And on top of that, my shares would have also benefited immensely. While this call is making me a loss, what we have to keep in mind is that definitely the shares have benefited. So overall, the position is doing well. I haven't seen such low prices on expiry in forever. It's I've not seen the at the money short straddle opening for less than 70 rupees in a long time. The at the money short straddle 65 at 9:30 in the morning, and yeah, Going by data, 15,700 should be the upside ceiling, and right now people will be writing the 15,600 put to no extent. That gives 15,500 a good strike on the downside. So more or less, I've kept my space from where I'm expecting maximum call and put side open interest to be, and that gives us a credit of not even 10 points. And for our hedges, we're paying close to, let us say, slightly less than 2 points. We have 8 points of credit for a 250 points triangle. So very low premiums. Market is not pricing in any movement. So let us see if it's in line with that. We will either take 8 points available or probably give up 5 if we have. Okay, so the Reliance position is now looking like this from the payoff, and more or less there is no upside risk as such. It's flat here, but the risk is of losing the potential upside. So luckily I covered only half the quantity of my shares with calls, but regardless, now these calls are bleeding. How I'm managing it is I have sold the 2000, the 2100 and 2200 puts respectively in quite a considerable quantity. Now in case Reliance starts to from this point starts to just consolidate in this range, then we have a good break here all the way almost up till 2300, wherein even the call that we sold will be profitable and our shares will also remain profitable. So for now the idea will be not to do a lot, but one consideration might be I might eventually square off this 2000 put position and increase the 2200 put position by 2 lots, making this a complete short straddle at 2200, and just keep a little additional put side credit. So that is one consideration. I'll not be in a rush to manage this. If this was naked, then the approach would be very different, but since this is not naked, um, gives me enough time to react since my upside risk is 0. Time is 9:45. Not a lot has happened in the market since the gap up. I'm waiting for the data to start building up. We'll keep you posted. So as of now, from the looks of it, 54% increase at the 15,700 call option, which at this point is just 35 points away from the money. So huge resistance building up here. And on the put side, 15,600 is starting to see a good amount of writing. 225% increase, almost 60 lakh Y at 15,600 put, and 73 at 15,700. So this seems like the most likely range, with now respectively being maximum OI on either side. And our triangle is a little bit safer than that by sitting on the 15,700 call and 15,500 put. I don't want to be on 15,550 put because the thing is the market is positioned in such a way that it's not even expecting a dip till 15,600 right now. The current pricing, there is no way that the market is expecting a dip till 15,600. It's just not even expecting a 50-point move in either direction with current pricing, because if there's a 50-point move, this will make a loss. This, which is short straddle, which is trading at 65, will actually make a loss if there's a 50-point move in either direction, even just to test once. So yeah, that's the kind of range. Like if anyone who believes market will move either 50 points up and down at any point during the day can go long on both of these and will get the opportunity to book a profit there. That's how tight the market range and positioning is. So yeah, I'm quite comfortable with my strikes being where they are. I'm gonna keep them there. Very risk off sort of a expiry trade. Okay, the time is 10:30, and So far, the hypothesis of the Atmani straddle pricing is that we will not even test, forget break, we will not even test 15,600 on the downside or 15,700 on the upside. That's the hypothesis of current straddle pricing. And going by open interest, 15,700 is now looking like the ceiling, the absolute ceiling, and 15,500 on the downside. With my position itself, I'm above the ceiling on the call side, but at the same time, I don't want to be at 15,700 because of the kind of shorts built up at 15,700. In case there is like a quick up move due to some uh, due to whatever, then the kind of short covering, this will double in matter of nothing. It'll double, in fact maybe triple, because of the kind of demand that will come in. I don't want to sit in the way of that. There's very good chance it's an ends out of the money, but doubles or triples intraday. It's very possible. So that being the case, going to stay away from that. And on the put side, sold the maximum put side open interest, right? So it has enough distance from the spot of 150 points to give us a reaction time. I mean, we'll be reacting to it even if we are testing 15,600 on the downside to take corrective action. Yeah, no premiums at all. And people who are saying pre-COVID premiums used to be like this, not really. You have to consider base effect. I mean, where was Nifty and where is Nifty now? So yeah, I mean, VIX keeps getting lower and lower, and or later dated options are losing a lot of steam. It also shows that potential upside from here has to be quite limited. And the way this up move has been going, there was a surprise amount of momentum that came in from the Reliance dash of 250 points in a matter of 4 or 5 trading days. But there's no momentum coming from anywhere else. Bank Nifty isn't exactly in some kind of a hurry to head back to its lifetime highs. Uh, Not a lot happening anywhere else. It's just Reliance that uh, forcefully gave that momentum to the index. So now will be a relative time to have lower risk. So how you should, I prefer trading the market is when the anticipation of risk is high. I prefer taking higher risk because the potential reward for it is high. When the anticipation of risk is low and you take a high risk, and which was supposed to be improbable to begin with, and then a high risk plays out, then it can be quite damaging to you. So I'm going to keep myself very risk off. More or less just following the concept of I can stand to gain about 8 points through the day, and I'm willing to give up about 5. So just good from a risk reward perspective. Towards the end, of course, I might move in closer and take in additional credit, but there is a long way to go for that. Won't be happening anytime soon. Okay, so since my trade has almost no significance in today's expiry, given that the current positioning of the market is not expecting more than a 50-point move from where we are on the spot. And the reason I'm not taking this 15,700, 15,600 strangle, which still has 21 points in it, the reason that's not my trade is because I have no intention of taking a 10-point stop loss today. There are a few reasons behind this. One, when market starts anticipating lower risk, you want to uh, see if the actual risk and the perceived risk match for a while. For now, lately, based on how markets have been just in the past few weeks, there has been a lot of violence on expiry days or otherwise. And so the actual volatility has invariably been slightly higher than the perceived volatility at different points. So I will wait for that phase to be played out over a while, where the actual volatility and the perceived volatility together are making sense. And then I can take trades which are 20 points or 10 point stop loss, stuff like that. For now, I'm very happy to have taken what I have, which is 10 points and 5-point stop loss. Strangle is now trading at uh, $5 and 5.5, and more or less absolutely no concern, because if you look at the open interest, 15,787 lakh and 15,500 57 lakh. 15,500 not looking that strong. That's because there's never been any premium in it. The reason these open interest are not going up is there's hardly any premium in it. People don't particularly care. And I haven't plotted the 15600 here, but 15600 will be even higher, right? Yeah, 70 lakh at 15600. So all this being the case, no point in doing anything. Just going to let this trade sit. Almost a 95% probability that we capture whatever is remaining. Okay, we'll go through some of the positional trades and why I took them when I entered them. During an up move in HDFC, since I hold HDFC shares at different points. So since I hold HDFC shares, I've sold a HDFC call, and also I'm not planning to add shares at these prices. I've sold a put, so that one, it will buffer my call so that I can make money on the shares also, on the call option also, and potentially take in some put side credit. So that's why I've sold slightly bearish strangle on HDFC. On HDFC Bank, same thing. I hold HDFC shares, which cover this completely, so I have no upside risk, and I'm taking in credit there. When we're at all-time highs, it makes sense to start booking some profits by at least selling call options. Some people might offload shares. I have no intention of selling these shares for the rest of my lifetime. And the only thing I will do is add them at different dips. So similar ICICI Bank up move, sold call option, taking credit there. ITC before results, IV was quite high as well, and there was a good up move of 15 points from the 200 support. At that point, sold the 220 call, taking some credit there. Same thing with Larsen. I covered these shares, sold a call option. Basically, selling a call option helps you realize some of the gains in case you have to, because you might be sitting on paper profits right now. You're not really booking it. How I'm doing it is by selling some call options. So Larsen sold a call option to buffer the call option, sold a put option, and the call option is making a 3-point loss. The put option is giving a 5-point profit. So overall, that position is doing all right. M&M cash secured put. I just want to add the share, but not at current prices. So just sold a put option. In case I get my price, I can look at buying it. Yeah, this is the ratio double calendar. Ratio double calendar is doing all right despite the fall in IV. I think when I entered this, India VIX was around 18, and these are July options. And but overall, the position is slightly profitable now. This is making around 60k profit in the short legs and a loss of 40k on the long legs. So yeah, about 20,000 profit marginally. I'll see what to do with this. For now, I'm fine holding it as is. Yes, and then here comes the trade that's losing us money, which is having sold call option on Reliance during the up move, as didn't expect the momentum to go so quickly as fast as it did. But regardless, my shares have benefited on this. This call option is losing, but is being balanced by the fact that at different points I kept taking in put side credit. And even now, this entire position on the upside break even is 2300, which means even if Reliance goes to 2300, from here my shares will benefit another 100 points, whereas this position will not give me loss. So all that being the case, it's been a very mum expiry. I think this is the perceived risk was also the lowest it has been in at least a year, right? So easily more than a year. This is the lowest risk perception has ever been, and the actual risk also, I think, in the entire year, I've not seen such a tight range in the first half of the market. The first half of the market we've had all put together not even 50 points of a range. So yeah, that being the case, we'll keep you posted. I don't see me having to do anything to this trade. At some point, I'll probably just adjust as averaging is starting, move in with the strikes a little bit, maybe get an additional point or two from that. But yeah, we'll keep you posted. Okay, the time is 1:30, and finally some weakness coming from Bank Nifty, which is below 35,500, has dipped almost 80 points below 35,500. And what I've done is about 40% of the position. On the call side, I have brought it down to the maximum of call side open interest, which is 15,700. And the idea is if we started it below 15,600, then we'll move all the 15,750 calls to 15,700. Apart from that, not much else. Yeah, this was trading at 50 for the longest time. Anyone, it just takes, that's the whole thing, right? So the pricing of options has been such a way the whole day that even an attempted test, not even a test, you don't need an actual test of 14,600 or 14,700, just a 50-point test in either direction was going to give you a profitable exit. Of course, this is now crashing immediately, but good enough expansion. You paid 60 bucks for it, you got 60 out of here and probably 15 of what the 15,650 call is worth. That's a 25%. Anyway, yeah, this is more or less the position. If you start heading higher than 15,660, then we'll be squaring off these calls and moving them back up to 15,750, where they initially were. That's why I moved only part of the position down in the entire move. Okay, the job of moving down the calls of 15,000 quantity to 15,700 was to protect these from expanding, right? In case we had a breakdown, that job is done now, so no reason to stay there with the calls. There's a long time left to go. There's almost 1 hour 20 minutes for averaging, so just no reason to have that position. Yes, it uh, has reduced my profitability a little bit, but that's perfectly fine because when these puts expanded, and if there is a cascade, the kind of expansion that will happen. So these I think went up all the way till about 5, yeah, 5 something during the expansion at 120. I will have to start covering the downside now. Just because I've gotten a bad deal on the call doesn't mean I want to just sit on the bad deal. The reason for that is while we are super range bound, premiums are dirt cheap with the 1 or 20 minutes to go for averaging. The at the money straddle is worth 43, 44. Market is not pricing in any kind of move. All of that is there. But my risk reward for the day is already defined. It's 8 points best case and lose 5 points in the worst case. So I'm not going to change that skew. Like why with the given open interest at 15,600 and 15,700, this will give me almost 15 points. Why am I not taking it? It's just because I'm not permitting myself to sit with that risk equation today. So look, just one dip in what kind of unwinding we saw at the 15,600 put. These guys are ready to get out. Right now, positions are very fickle. In case there is a break on either direction, the opposing party will not wait and sit around. They will get out of that position. So anyway, 1 hour 15 minutes to go for averaging. Anyway, during averaging I will take in more credit, so that should give me a little more than this potential 4 points that can be captured as of now. Okay, the time is 2:20, 40 minutes to go for averaging, and we're sitting on pennies. Basically, this triangle has value of 3 and my exit criteria would probably be 5. And I'm sitting on this positional spread, which is not very attractive to hold on to anymore. So obviously it didn't work out as intended because of the fall in India VIX to the extent. And also now with the range breaking, I'm not overly comfortable with the trade. The trade itself is not losing any money as such. It's at break even. So we're losing about 45,000 here, gaining about 45,000 here. The trade is at break even. Actually take a look at it. So it's more visible to everyone. Okay, so this is where the trade is in. I no longer think of this trade as a very good trade. In fact, I was expecting some kind of consolidation around the 15,500 range itself, which didn't happen. And too early on in the trade, I am seeing a move away. And if And that too, this was prior to Reliance making the breakout move that it did. So now that Reliance has made that move, some of the conditions of the trade have changed, and Bank Nifty might eventually play catch up as well, which is why it's not a very good trade to be in. I'm going to cut out of the entire trade. See, the thing is, we have a tendency, it's called getting married to our trades. We all have a tendency to, I think, fall in love with the trade that we've taken, said, this trade only has to make me money. Uh, and we don't normally go back and assess, is it still, you can try to fight it and somehow get out of it making money. But if you're already not sitting on a trade, that's really great. Like, would I want to be in this trade right now? Would I want to have a bearish view on the market from where it is overnight? No, that's not where I am. So why am I in that trade? So taking the exit. Hopefully, I don't have too much slippage by doing this. Trying to execute it slowly. To execute it properly. Yeah, execute it fine. So yeah, look for proper trade opportunities. Don't try to force a trade to give you profit when the conditions under which you took it have now changed. I was expecting an increase in IB from there, and that view went wrong. Now, why do I need? But because it was a hedge trade and because it could benefit from multiple criterias, the decay that I got over the short straddle benefited, and overall the trade. That's why it was still in a mild profit. No need to hold on to it beyond that. Okay, okay, that takes care of that. Overall, okay, so overall, more or less, just slight mild profit after exiting. Yeah, we have 35 minutes left to go for averaging, and looks like people, even with people who agreed that the actual risk is going to be as low as the perceived risk, and were able to hold on to the position even when we dipped till 15,600, would be making good money on this trade. 22 minutes to go for averaging, and this executed order. Um, Currently, I'm sitting on a 200 points triangle with 2 points in it. I moved up the puts to 1550 because there's no value left in 15500. They're trading at 2 points, and yeah, the idea is more or less these points, 2 points will go to zero. In case it doesn't start expanding to something like 4, then I will cut out of the losing position if there's momentum. The only way this expands to 4 is there's some big momentum in either direction, and then see if I can play the momentum in some way. Uh, but yeah, that's more or less it. Most highest probability that this 2 points goes to zero. Of course, my hedge also goes to zero. Um, so yeah, 1 rupee 35 paise is what we're actually in the trade for. Okay, we have 7 minutes left to go for averaging, and more or less there is in this position about 150 left to gain, and our hedges will lose about 50 points. So 1 rupee. I might make some changes towards the end, taking in additional credit. But right now, the way market is positioned, it is looking like a 15,650 picture finish sort of a situation. The strategy is trading at less than 25 points with 7 minutes to go for averaging. So that's what it's positioned towards. But we've seen in the past few expiries, we have these rapid moves in the last few minutes as we head into averaging. We've seen 50, 100 point move in either direction. So I have my exit orders ready. I'm waiting with, and also waiting with a couple of orders to change, like move the call down to 15,700, move the put up to 15,600. This is what I'll do once averaging starts, not until then. I'm giving myself a leeway of about 2 points to lose. So 2 points is what I can potentially lose, and beyond that, I cannot afford to stay into. So, looking like a picture perfect kind of finish. It's like the market. It's like, will you call my bluff? Will you not call my bluff by giving us terribly low premium? So, more or less, the market's expectation was in line with what happened. We had one of the narrowest ranges I've seen in a very long time, and yeah, fair enough. We'll have to observe over next few weeks how risk is priced and how actual risk plays out, and accordingly define risk reward. Today was definitely, or a very, very, very low risk sort of position. But that's the trade I wanted to trade. That's the trade I took, and fair enough. It still should amount to a 1% return. This position is actually showing a loss now because of having exited it, but this loss doesn't mean it. So it's because I've just closed this position, just exited a trade, but on a because I've exited that trade, it is showing the loss. This is not realized loss in any way. Okay, averaging is starting, and we're seeing an up move into averaging. Now let's see how strong that up move will be. I don't have to be concerned about this, not yet anyway. I might as well move to the 600 put. 650 put is also an option, but I don't want to take on that risk. Okay, there's no way the average reaches 15,750 or 15,600. And the first 3 to 5 minutes, if we're not making such a breach, then that breach is unlikely to happen. No matter what happens, it's just not possible. If you don't know how the averaging thing works, then you need to watch my previous expiry video where I've gone over how averaging works. Just leave it as is now. Now, why bother trying to greed for 60 paisa more? It's the execution headache. Okay, 6 minutes in, and we have not broken 14,700. And to look at the average price, what is Nifty average? Just look at any option that's in the money. So Nifty average is something like just about, I mean, this will have 1 or 2 points of time value in it, so should be about 15,680, that range. You can keep seeing how this price changes, and that will give you the average. This position is almost certainly going to end worthless. In the last moment, the move is coming from Nifty IT. So I don't know, they do investigation into Infosys insider trading. They should find out who's taking like large positions in IT one day before and on the day of expiry, because yeah, that would be an interesting investigation. I mean, not today, not particularly today, but at least for the past few months, IT always acts very weird when it comes to weekly expiries. One day before weekly expiry and on the day of weekly expiry. Anyway, there is 50 pies left, and the hedges are going to lose some amount. So should overall amount to a 3% return. Uh, this is showing a loss, but this is just because exited a trade. We'll keep you posted. Now there's almost no way that the 15,650 put or the 15,700 call have any value. They will both most likely go to zero. So 15,650 put is just 60 pies. There's no point in making the effort. 15,700 call has 1 rupee, but yeah, just not worth making any change. It's fine. I'll just hold on to this as it is now, because even if it is going to end worthless, a continued up move the way we saw last week, it's better to stay away. Is what I'm feeling, and yeah, we'll keep you posted. Should be getting auto squared off in 17 minutes. Should be getting auto squared off anytime now. Was a alright expiry. It was an interesting expiry, and all said and done, I think the pricing of risk in the morning was fair enough. But I've taken a very low risk sort of an approach, and I hope you had a good expiry trade. And yeah, it doesn't look like I'm going to be able to sell these, so they'll expire worthless. But yeah, thank you so much for watching. I hope you had a good trading day, and I will catch you tomorrow. Take care.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram, and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab, so do not forget to check that from time to time.